you say a good deal of stress could have been avoided if, like the Fed, investors actually paid some attention to the data.
Yeah, I think there's two things here. One is, first of all, Jamie Dimon is saying that the Fed should hike rates, and that is a different discussion of whether they will hike rates. When the discussion comes to whether the Fed will hike, they have continuously outlined, they focus on the data, and the data has been very clear that is not compelling, does not justify a hike right now, and that's why nothing new came out of Lael Brainard's speech last night.
Yeah, in many ways we should have just paid attention to the data. Ewan, it's a very fair point. We could all have this theoretical great discussion about whether or not the Fed should raise rates, but will they raise rates, I guess, is the bigger question. We've now got the work function at a mere 22% for September. Is it over?
I don't think they're going to raise rates in September, Guy, simply because of the market shock. And you can see from their response function, in the sense they're scared of the shadow of the market. But I think that we'll see them say pretty clearly, give a sign towards December. Now, if you look at what's happening at the data in the US economy, it's been slowing down until about 3 months ago over the last 12 months. Still growing, but at a slower rate. Seems to have leveled off the last 3 months. Maybe it's going to pick up a little bit to the right, which is why this is function on the employment level. And I think the debate in the Fed is that slowdown going to go another step down? Is it going to stabilise?
Yep.
And what's going to happen to employment? That's why there's this split.
And I just want to take it back to Mark, because it was a great piece, of course, that you put out today on the risks. You highlight what was said. It's all about inflation undershooting, labour market slack persists, markets are surprisingly interconnected, and the neutral rate is lower now. All these points being laid out by the dove at the Fed. What, in terms of the data, should we be looking forward for this week? Because we do get inflation data.
Well, I mean, I think on all the data, you need to look at, first of all, the whole picture, and some people would argue that's mixed, probably mixed at best. But when it comes down to the deciding points, why not look at what the Fed have guided us towards to look at? So, for example, they like inflation. The most important thing is, if it's a mixed picture, is the core PCE. That hasn't hit target for more than 4 years, and it's actually moving farther away from target. Again, the broad labour measure has actually been negative most of this year, apart from July. So, you know, none of this is surprising. Their preferred measures of data are not particularly positive, and it's not like the rest of the picture is particularly good either. Look at recent ISM.
Mark, if we listen to the headline out of what is coming from the Fed, yes, I take your point that we should be listening to all of those things, that we should be paying attention, but there are papers coming out from the Fed, and this kind of stokes the theoretical argument. And one was out a couple of weeks ago talking about the idea that we're getting very long in the tooth in this expansion, albeit a very mild expansion, but nevertheless the Fed needs to start preparing for the next downturn, and it has nothing left in the locker. Is there an argument that says actually what is happening kind of at a headline level needs to be taken in the context of the bigger cyclical story and what is happening there? The Fed needs to prepare, it needs to think long term, and as a result of which it needs to get more ammunition back on the rack so it can start actually preparing to cut again, so it needs to raise in advance of that.
I think that's 100% right. I think the big issue for the Fed is that they're worried that they've missed the boat. They're too late in this cycle to suddenly hike now. And maybe they need to re-examine the whole process, the whole framework with which they make these decisions. And Jackson Hole was part of that. And all the speeches over the summer have implied they've started that process of examining their whole monetary policy approach. And that may be the right thing to do. But they can't suddenly surprised by a hike now without warning people that they're changing their whole approach. That would completely eradicate any last vestiges of credibility they have left. And so they may start examining the process, but they won't. They'll warn people if they're going to change the process before they suddenly start hiking. Maybe that's what they should do, but that's a different conversation to what they will do.
Mark, it's interesting you outlined in your paper. I want to bring it back to Ewan. You mentioned LIBOR. Ewan, on my screen I'm showing the sudden ramp up in LIBOR. Yes, we're nowhere near 2008 figures, but this money market reform is starting to pinch in terms of liquidity potentially in the market, the cost of funding for banks. How much is that in the Fed's perspective, do you think?
I think it's in their minds, just as the banking industry is in the minds of the ECB and the Bank of Japan and indeed the Bank of England with the shape of the yield curve. And I guess that may be one of the reasons why Jamie Dimon is saying so loudly, let's have a rate rise, because steepening yield curves are good news there. Look, the monetary conditions in the United States are not particularly hot, they're not particularly cold, they've tightened a little bit. But I think this debate about are we going to, just because the the growth has been going on for so long, the length of the cycle, we must have a downturn immediately. It's kind of a bit odd. If you're arguing that it's a below-trend recovery, then you could argue it could be an extremely long and drawn-out business recovery. And I think that's what LIBOR is telling us, and I think that's what the numbers are telling us, that it's not going to crash, but equally it doesn't feel like it's going to take off.
Ewan, very quickly, what do we buy in this circumstance then? Are you still long US Treasuries?
No, US credit, I think, is the place to be, and high yield. I think that if you feel that the yield curve is only going to steepen mildly, then the pickup in yield you get there compensates you for the duration risk.